Welcome to the current federal tax developments for the week of May the 23rd, 2016. Get the right month in here. This is current federal tax developments are brought to you by Nichols Patrick CPA Incorporated and your state society of CPAs. What we're going to have this week as we take a look at our developments, and I will warn you of one thing. We are going to be looking this week a little bit early. I'm actually recording this on Thursday afternoon. So if on the off chance that Congress met on Friday and they decided to totally repeal the Internal Revenue Code and the president signed this Friday afternoon before we left, then basically, that's not going to be in this week, so I have to post something somewhere else. But otherwise, because I'm going to be on the road in Toronto beginning tomorrow, I decided to go ahead and report it. We're going to still have it up and it'll be running, but we'll take a look at what's happened this week. And this week we have a few interesting things that have happened, even just stopping at Thursday. We're going to take a look at a case of a new attorney who lost his challenge to a almost 50-year-old regulation by claiming that, we should go back and revisit whether it was valid. The tax court declined to do so. We then get some regulations that allow us to use designated Roth IRA accounts and roll them over easier into regular old IRA accounts, Roth IRA accounts. We also say there's always gotchas. We got two of those this week. The first one is a taxpayer discovered that text in a treaty that made a transaction non-taxable turns out didn't apply to him because there was more text later in the treaty that would override that in his case. We also find that if the IRS takes your money, your refund, to pay a debt to another government agency, and that agency really is, asserting you owe money when you don't, or at least you claim that's the case, tough luck. You can't ask the IRS or the tax court to step in and solve your problem for you. You have to go talk to that agency. And finally, the next gotcha, we do discover good news for legal marijuana sellers. They can qualify for offers in compromise. The IRS won't treat that as against public policy, but we discover a major league gotcha about that offer in compromise is going to make it a little less helpful to you than you might otherwise have hoped for that offer in compromise to be. As I say, current federal tax developments brought to you by your state society of CPAs. Now, as we all know, keeping up on tax law is not easy, and actually it's fairly tough to do. So keeping up being tough, this is the time of year when we have to start planning our continuing education. And speaking particularly to those of you in Arizona who know that this is the week for your early sign up, that if we go past the end of May, you lose that right. Remember that now is the time to go into the catalogs. If you haven't done so already, please go take a look and look for the courses. We certainly hope for any of your state societies that you'll go ahead and consider the Nichols Patrick courses, but there's lots of other very useful courses and very helpful courses. The advantage we have here is that the state societies are able to give you full day courses on much more specialized topics than you can easily find elsewhere. And because of that, and because specialties are a major component of what we need to be looking at today in our practices, the State Society CP provides you with extra value. So be sure, check your catalog, find out what's coming up. For those of you in Arizona, I'm going to be doing some work later this month. So I'll be speaking both in Phoenix and Tucson. I have a number during the summer that I do here in Arizona. And as we mentioned last week, we have Don Cochran and Butch Rogers out on the road. So be sure that you go out there and take a look at your various state societies and look for the courses and sign up. With that, let's go ahead and start looking at the first case we're going to look at this week. And this particular case, which is Santos versus Commissioner, Tax Court Memorandum Decision 2016-100. This particular individual was an enrolled agent who was involved in tax practice. Now, Mr. Santos decided that, you know what, I think I'm going to go ahead and I'm going to go to law school. I'm going to go to law school. I'm going to get my law degree because, tax practice involves dealing with the law and interpreting law, interpreting cases. And this, is very useful in my tax business. So Mr. Santos did that. He finished law school. He passed the bar exam. He became a member of the California Bar. Now, he decided to claim a deduction for his tuition on Schedule C. That's all wonderful and great, except the regulations, as we all know, years ago told us that you cannot take a deduction for any amount you pay for educational expenses if the expenses qualify you for a new trade or business. And in fact, as is noted here, one of the specific examples in the regulation of the sort of thing that would qualify you for a new trade or business is an individual who's not an attorney going to law school, getting the law degree, and passing the bar exam. The expenses for that tuition and fees are non-deductible business expenses. They're considered to be capital expenses, never deductible, that involve the setting up or getting started in a new trade or business. And that's true if you don't qualify for a new trade or business. Mr. Santos said, well, that regulation to me seems unfair. The court said, well, yeah, but we decided in 1969 that this regulation was valid because the regulation was actually issued in 1967. Mr. Santos pointed out, though, that, the rules had changed on deciding whether a regulation was or was not valid over that time frame. The court said, yes, that's probably true. But if you take a look at the key case, the Mayo Foundation case from a couple of years ago, you may remember in that case, if anything, it made it much tougher to establish that an IRS regulation was invalid, because under those rules, a regulation could only be invalidated if A, the law itself was unambiguous. In Section 162 in the area of deducting education, what's ordinary and necessary, that's far from being unambiguous. And then number two, the problem was the IRS's interpretation reasonable? And the court had long ago decided, when it looked at the 1969 case, that the regulation effectively had decided it was a reasonable interpretation of the law. So they said, you know what? Basically, Mayo's not helping you here. We said, well, yeah, but you guys went on, and in a case last July, in the case we had of Altera Corp and Subs versus Commissioner 145 TC number 3, you had held that a regulation was invalid because the IRS had not properly considered commentary they had received on the regulation when they had the proposed regulation outstanding. And Mr. Santos wanted to argue that, in fact, there was commentary out there that the IRS didn't properly take into account in 1967, and that should allow us to invalidate the regulation now. The court, unfortunately, didn't agree with him on that point. Actually, it pointed out in one minor issue that he didn't raise this argument till very late in the process, and that effectively it was too late for them to consider it anyway. But they point out, even if they considered it, Altera was distinguishable. In Altera, they were looking at not the interpretation of the law, but rather, they said, an empirical determination, and that in no way depended on interpreting the law as written. In this case, we're looking specifically at the law as written. The court said Altera couldn't help you even if you could argue it. So, while Mr. Santos may have believed that, in fact, he was going to get this win, it would have been a nice big win for a brand new attorney, because he became a member of the bar in 2014, and he's trying this case now. So, it's an early on in his career case, although he'd been involved in tax practice much longer. But it turns out that, it's just not going to quite work for Mr. Santos. He's kind of stuck with where he's at. The next case coming up, we take a look at the IRS. The IRS issued this week, and this is Treasury Decision 9769. It modifies Regulation 1.402A1, Answer 5A. And this was issued here on May the 17th. This is a rule that deals with rolling over from a designated Roth account. And what the IRS did, this goes back to Notice 2014-54. Notice 2014-54, the IRS changed the rules and said, you know what, sometimes people roll over balances into an IRA at the same time they take some cash out, because they might have both before and after tax dollars in the account. The IRS, in Notice 2014-54 for IRAs in general, provided a rule that said we would no longer treat each distribution, the rollover, as a separate distribution from the non-rollover. Why was that important? Because generally we have to prorate the basis in that case for each distribution. So if, let's say, the total value of the pre-tax dollars in the account represented 25% of the value of the account, then we'd have to treat 25% of each distribution as basis. And that's a problem, because if we're rolling over into the IRA account, we can only roll over the after-tax amounts. And the other problem we've got with that structure is that means any cash we take out has that same problem, that issue of having part of it being considered non-taxable or considered taxable distribution. What we'd like to do is roll the amount that would be a taxable distribution to the IRA account and be able to take our basis out. And in Notice 2014-54, the IRS allowed us to do that. but they had to modify the regulations because the Roth IRA regulations made it very clear that you had to treat the rollover as a separate distribution. What they did was got rid of the sentence in that answer that required that. They also said it would be effective for distributions after January 1st, 2016, but you could electively apply it all the way back to the date notice 2014-54 came out. This is generally a positive issue for our clients. If you've had an issue with a client who did this rollover and the plan custodian did not follow this rule, you might want to talk with them. Or if you're taking one now, or if you run a plan where there's a designated Roth IRA account, balances in them, you want to take into account this special rule, which allows the beneficiary to designate how much goes to each account. By default, if the beneficiary says nothing, the dollars going to the rollover account are presumed to always come first from the taxable distribution, meaning that if the taxpayer only makes a rollover equal to the taxable amount, the entire amount coming out in cash would be non-taxable. That's the kind of thing that our taxpayer would probably normally like, and that's one which the participants probably would suggest they'd prefer to have happen. With that, let's go on to our next case here. And we have another case coming up here as we get ourselves going. This is going to be a case of somebody who just didn't read far enough. This is the case of Cole versus Commissioner, Tax Court Summary Opinion 2016-22, issued on May 16th of this year. This gentleman had been he's a U.S. citizen. He had moved to Israel and became a permanent resident of Israel. Now, Israeli law has a special rule that says within 10 years after moving to Israel, if you sell something at a capital gain that you owned before you moved into Israel during that 10-year period, there's a tax holiday. So this gentleman would pay no tax to Israel on the capital gain. Now, of course, U.S., because he's a U.S. citizen, would go ahead and tax that money, except Mr. Cole found a provision in the U.S. in the treaty with Israel that provided, which is right there, no tax can be imposed by the non-resident country on any capital gains recognized by a taxpayer. So the bottom line was, he said, hey, that looks great. I sell this stock. Israel won't tax it because I'm within my 10-year period, and the U.S., per the treaty, doesn't tax it. Well, that was great, except there's a little problem here. If you actually take a look at the treaty, what happens in this case, the provision he was looking at in this case was that he had an Article 6, Paragraph 3, or basically we should say that Article 15, which was the one he read, was the one that said they can't tax the capital gain. But Article 6, Paragraph 3 has a provision that says, notwithstanding any provisions of this convention, except Paragraph 4, which has a list of times where this clause won't apply and the capital gain rule isn't in there, a contracting state may tax its residents and its citizens as if the convention had not come into effect. The tax court pointed out they had long ago ruled that this type of clause, known as a savings clause, overrode the more specific items below it because that little word notwithstanding any other provision. In essence, it's going to automatically apply. Now, Mr. Cole said, well, that's crazy. It tells me it's not taxable. Then you turn around and say, but the U.S. still gets to tax it. The court said, well, it's in a limited case. If you're a U.S. citizen, they're going to get to tax it, even though it's during the period you moved to Israel, because the U.S., since you're still a citizen, will still have a right to claim that tax. They said, if you weren't a U.S. citizen and you were in a potential double tax situation with the United States and Israel, and you didn't reside in the United States, then this treaty would serve to give you protection. The key thing it points out here is something important for us in tax research. Lots of times in tax research, we tend to suffer from what can be referred to as confirmation bias. That is, I know the answer I want. The client wants to, let's say, understand that this will be non-taxable. We go ahead and we read, we get the treaty out. We look at clause 15 because we scan the treaty for capital gain, and voila, here's a provision that says exactly what we want to read, that this taxpayer will not pay taxes to the United States on this capital gain because he's not residing in the United States. And this clause says that the non-resident country can't collect the tax. And then we stop reading. That's the problem. Unfortunately, these sort of clauses or these sort of provisions, whether in a treaty or in the law, there's often provisions that may contradict something you see elsewhere. Now, that makes it difficult because we all know that the treaty represents the actual law, and we know that that's the highest level of authority. But we have to make sure there's not another similarly high level of authority, like another clause in the treaty, that overrides us. While things like the services like the Federal Tax Coordinator or the Standard Federal Tax Reporter are not authorities in and of themselves, they are very useful if you're doing tax research to discover cases like this, where you can find things where if you read an explanation there or in a B&A portfolio, you probably immediately run into this special discussion of the savings clause. And specifically, if you're looking at capital gains, United States, Israel, you probably would discover very quickly that the savings clause is going to override that thing found in clause 15. Tax research is, frankly, hard, but it's important that we get it right, because in this case, obviously the problem was somebody, and we have no evidence here that he was talking to anybody but himself, so we don't know that he did anything but did this research on his own. But clearly, whoever did the research, whether it was Mr. Cole or whether it was somebody else, they just didn't read far enough to truly be able to make this work, and that turned out to be a major problem for them. So we ended up with our little problem here and our little issue that we ran into. Okay, next up, we're going to have another little problem somebody ran into with an issue, because this involves a taxpayer. As you may be aware, the IRS can offset refunds for various reasons. In the case of Terry versus Commissioner, Tax Court Memorandum Decision 2016-88, issued on May the 3rd, this taxpayer had been a government contractor. He had a contract with the federal government. The General Services Administration determined after the fact that he had been overpaid. The General Service Administration therefore said, Mr. Terry, you owe us money. Mr. Terry does not believe he owes the GSA money. He does not believe he was overpaid. However, when he filed his next tax return, he was getting a refund. The IRS took that refund. They offset it against the GSA account. Now, that amount was never returned to Mr. Terry, but a couple of years later, he discovered that there was a problem on the return he had filed, so he filed an amended return. On the amended return, he owed additional tax, but the additional tax he owed was less than the refund. Mr. Terry said, hey, guys, you know what? I actually paid you guys more money than I actually owed in tax, even with this particular adjustment. And, you know, so I'm really even, and the GSA may have taken the refund, but you know what? They really should have taken the refund because I'm not owed that money. He said, so therefore, even though he filed a 1040X, he didn't send the money in. The IRS, of course, tried to collect from him. Well, when he had his collections due process hearing on this issue, he was arguing, of course, that the GSA he didn't owe money to the GSA, so therefore he had overpaid his tax, so therefore he didn't owe this money with the return on a 1040X. The tax court, agreeing with the IRS, said, tough luck, you've got to take this up with the GSA. The tax court nor the IRS do not represent the proper venue in which to raise this issue. Rather, you need to go back there. All the IRS can do, the only way the IRS can take money back from the agency that said you owed them money is if the IRS determined they had made an obvious clerical error. Let's say, for instance, they had sent more money over than existed, or the GSA had said you owed them $5,000 and they sent the GSA 10. They could turn around and say, no, you got to give us the $5,000 back. But in this case, where you have a later amended return, the IRS does not have to go back and say, you know what, his refund wasn't really that big, so give us back the excess. Nor do you have any right to try to raise the question of whether the GSA, whether you really owed the money. You have to raise that in another venue, not here. The tax court nor the IRS is not the place to try that issue. Next up, and finally, we're going to take a look at another gotcha problem. This is the case, Small Business Self-Employed Division Memorandum SBSE 05-0416-0016, issued on April the 28th. This takes a look at where we have various states that of some form or another have legalized the sale of marijuana in some cases. It still remains illegal on the federal level. The question becomes, if one of those marijuana selling businesses ends up with taxes that they haven't paid, and they come to the IRS and said, we need an offer in compromise because we're not going to be able to pay this tax in full. Can the IRS grant them an offer in compromise? Can they compromise the debt? Or does this fall under the general rule that the IRS can deny the offer in compromise if doing so would violate public policy concerns? Generally, the IRS position has always been that if you had income from an illegal activity, and illegal is judged by the federal illegal side, then the IRS, it's against public policy to give somebody an offer in compromise where we're compromising taxes that arose from an illegal activity. So the question becomes, well, can we actually then do an offer in compromise in this case, or doesn't this violate public policy? The IRS in the memorandum considered that while this is illegal under federal law, the states have made it legal. And so the IRS concludes that, in fact, this is not going to violate the public policy clause. So they're going to say, hey, guys, we can do an offer in compromise. But there's a gotcha. The big gotcha is that the IRS in the memo concludes that in computing the income available to pay taxes in the future, the IRS is to go ahead and use the special rule under Section 280 Cap E of the code that applies to entities that sell controlled substances illegally. And what that rule says is no deduction is allowed except for the deduction for cost of sales. So what that means is, from a practical standpoint, the IRS is going to say, if they continue to operate this business, let's say it's a medical marijuana business in a state like Arizona that allows for the sale of medical marijuana, that we're going to allow them, but we're going to go ahead and take their gross profit, assume that's all available to pay taxes, and therefore not leave them any money to pay rent, utilities, office supplies, or anything else of the business. So from a practical standpoint, what this really means is this taxpayer almost certainly cannot stay in the business of being a marijuana dealer, even though it's legal in the state, and obtain the offer in compromise. They virtually have to abandon the marijuana business or they won't get it. So good news, offers are available. Bad news, they're not going to be available unless you abandon that business. So we'll see how it goes. Again, this legalization of marijuana is creating all kinds, legalization of marijuana in some states is creating all kinds of weird tax results. And these are all things that are just, beginning to come forward because of this, the provisions in federal law, especially that 280 Cap E provision. This has been the current federal tax developments for the week of May the 23rd, 2016. Be sure to go online at our site at currentfederaltaxdevelopments.com and catch the daily updates. You can also sign up for email updates there as developments happen. Another new development this week, if you are an iPhone user or an iPad user and you subscribe to podcasts via iTunes, you will now be glad to know the Current Federal Tax Developments podcast is available in iTunes, so you can subscribe to it via iTunes. Now, iTunes is somewhat inscrutable, we'll say at best, in finding things in this case. So what I would say is, but if you search for Current Federal Tax Developments in the podcast section, you should find our podcast. And if you subscribe to it, then every week as we post the audio, it will be delivered to your phone. You also can still come online on our site and take a look at Current Federal Tax Developments on the web. We also are in the Pocket Cast directory. So if you use that podcast client, you can listen to us via Pocket Cast and easily subscribe by searching in Pocket Cast. We are hopefully going to be listed shortly in Google Play, which is if you have an Android phone and you're using the Google Play app, which now just recently got the ability to do podcasts, you can download it there. I would still recommend you go get Pocket Cast because I find that a much nicer podcast client on Android, and actually a nice podcast client on iOS. But in any event, we are available now for downloads that way, or we have a pure RSS feed. Be sure also to check your state society's website for the full-day continuing education courses we're offering here at Nichols Patrick CPE, and also for the courses offered by other vendors. So as I said, if they repeal the Internal Revenue Code on Friday, I will probably post some additional information once I get back from Toronto. But otherwise, join us next week if they don't repeal the code on Friday, and we'll talk to you about what's going on in the area of federal taxes. So be sure, come back, and I'll see you next week.